Well, the government has made a very interesting announcement yesterday that PF or Provident Fund will now be accessible or very soon be accessible through an ATM or even through your Google Pay or your UPI account, making it really easy for you to access your own money, less paperwork, less stress in case of emergencies. Remember, it is your money. This seems like a great solution. So in this video, we're going to break down exactly what has been announced by the minister, what the current rules are, who will benefit from this and what it means for our economy, and if it is finally a good idea from a money management point of view. So quickly first as to what has been announced, the Labour Minister Mansukh Mandavia was speaking at a television platform yesterday, and he said the government is working on letting the EPFO or the Employee Provident Fund organization help members withdraw money out of an ATM or out of a UPI, bringing quick digital access to their retirement savings. Now, here are the key points of this announcement. 75% of your money can come out through an ATM or UPI once the system goes live. This includes employee share, employer share, and interest, which is normally very hard to get all together. And the new system will make the EPFO reforms faster, simpler, more worker-friendly. This is expected to be announced in March in the coming year. So by April new financial year, we can expect it to be active. This is part of the modernization of the EPFO. Now, before we go into the details, let me quickly remind you, PF is a compulsory deduction that is made in the salaries of formal employees or salaried employees. So it's calculated as a percentage of your basic. It gets deducted directly from your salary TDA, when it comes at the source. The employer matches the contribution. So for argument's sake, if if they've deducted 2,500 from your salary, the employer has to give another 2,500. So 5,000 rupees goes into your PF account, and it gets a very high interest rate, like 8.2, 8.3. It's higher by almost a percentage point from the normal fixed deposit rate, and it is tax-free if you keep it in for a long period of time. Also, it is made particularly hard to navigate in order to encourage you to stay invested until you retire. Now, let me give you the theory behind this. Unlike countries in the West, where irrespective of what work a person may have done through their career, when they retire, their government looks after their pension. And when they need to go into, a senior care home to be looked after, it's completely free and funded by the government. In India, that is not the case. Nobody looks after your retirement. You have to either invest and get a pension, or you only get a pension if you are a government servant. In India also, remember, you work until you're 60, and then from 60 to 75 or 80 or 85, as the life expectancy may be, there is 25, 30 years where you're not working, where you need to survive on your savings. And we're not great at saving in this country because it's expensive. Real estate is expensive, school fees and college fees are expensive, healthcare is expensive, weddings are expensive in our country. And so people tend to not have any savings at the end of the month because something tends to derail them. So this was an idea theoretically where they deduct the money straight out of your account when it comes into your account in your salary. It gets put aside, and it's made extremely difficult for you to access until the age of 58, so that you've been forced to save your own money, but it's forcing a type of behavior. Now, what this change will mean is that PF subscribers will be able to access the money from a bank ATM. So right now, the big criticism with the EPFO is that it is painstaking, eye-gorgingly difficult to negotiate or do any work with the EPFO. You have to fill forms, you have to get approvals. It stretches into weeks, sometimes months. Sometimes they'll have like some small bug with your ID, and it's an old, painful government system that is really difficult to navigate. This will effectively mean that you can just take your money out from an ATM or from your UPI account. And we don't know if the eligibility gets changed, but as it stands right now, it will actually make things much simpler. You won't have to fill forms, you won't have to wait for approvals, processing time will happen quickly. This will actually restore a lot of dignity to people. Now, the changes have been announced and approved in principle. They are not live yet. Like I told you, we're expecting them only next year. What are the current rules? So the EPFO currently has about 25 lakh crore rupees, which is about 8% of our entire GDP, invested in EPFO and long-term savings. Like I told you, it's a forced saving. You have access at the age of 58. If you have partial withdrawals are allowed if you've served for a minimum period, plus only in case of medical emergency, education, marriage, housing. And you can withdraw 75% if you've had job loss and you've remained unemployed for a certain period of time. Now, in all of these cases, though, the idea is that PF is accessible but not instantly, and the system is deliberately difficult in order to protect those savings. So this would be a huge change, a huge benefit for people, because it will also give you dignity, it will give you speed in case of emergencies. People will need to use credit cards less, personal loans less, money lenders less, and this will apply to all workers. So MSME workers, private firms, small private firms, contract employment, everybody will basically get access to quick money, which is your money. Plus, it will sort of drag the EPFO out of the Stone Age into the modern world where the rest of our banking system is completely digital. It will genuinely help people. These are all the positives. But there are some risks. Let's take a look at what could possibly go wrong. Retirement savings erosions. PF is meant to compound over decades and decades, which is why the government gives it such a high interest rate. Remember, I told you it's about 1% more than the average fixed deposit rate. It's also, this is the money that is used by government for long, big infrastructure construction, because they know that this money is not going to be needed immediately. So, one, the economy needs for us to put this large amounts of money away. Two, if we have easy access through an ATM or through our UPI, we might actually start spending that money right now instead of keeping it for when we get older. So it could become our fallback fund. It could become our consumption account. We might end up with little or no savings in our old age altogether. UPI and ATMs are designed for speed. It's good for payment. It's dangerous for long-term savings. We might do impulsive withdrawals, and there'll be less long-term planning. Also, who's more likely to withdraw early? Younger workers, lower income workers, people with unstable jobs, so people who are likely to receive more financial shocks. And this is the big one. This is a big risk, according to me. Linking PF to UPI and ATMs will increase the risk of cyber fraud, of basically attacks onto the account where the money just completely disappears. Right now, that's not the case because it does not exist in the digital world. It's all locked up. But it will actually expose this large amount of money to fraud, and strong safeguards will be essential before we actually make that happen. Like I said, the EPFO manages about 25 lakh crore rupees right now. It's one of the largest pools of long-term savings in India. It's invested in government bonds. It supports a capital market as a base. It acts as a strong, stable, long-term funding for the economy. Now, if large amounts start to be withdrawn early, there will be some shocks that will happen to the system in terms of the economy. Long-term saving pools will shrink. But let's also imagine if a portion, 75% of this 25 lakh crore rupees becomes accessible to average Indians, the amount of spending that will happen will suddenly boost and rally our economy, and we will suddenly have consumption that happens, and people will suddenly have cash in their hands. There will be, in the short term at least, there will be a fill-up to our economy, and there'll be like an increase in consumption. Remember, most consumption goods companies are telling us that people in the middle and lower income brackets are actually not spending on shampoo, on soap, on detergent, on things like this, but the spending is actually happening on the top of the pyramid where people have access to discretionary spending. So which means that there is a problem among the worker among workers to have access to money to spend. Now, could this be the money that they could actually have access to? So there are pros and cons to this decision. Like I said, it's a classic trade-off. We'll have to actually watch and see how the government makes this available, and if there are any guardrails that are actually placed for people who are withdrawing this money in terms of discipline, in terms of rules, and of course, like I said, in terms of safeguards when it comes to cybercrime. Leave me a comment in the comment section on what you think the result of this decision will be. Good thing or bad thing?